One of the pet peeves that I have out there is misinformation about the field of international tax. So since I'm an international tax expert, and since that is what we do at Offshore Citizen, more than probably anything else is help people with global cross-border tax, it is always annoying to me when I see people put out information that is just patently wrong and deceptive. And today I'm going to talk a little bit about something that Andrew Tate said in a clip. We're going to show the clip in a second, which was frankly wrong. And I don't know a lot about Andrew Tate. I've never met him. I'm not a part of his group. I certainly have lots of friends and people who are clients, etc., who are. Sometimes he seems to say things that are really smart. Sometimes he seems to say things that are complete nonsense. But certainly when somebody says things that are in my field and I know they're nonsense, it doesn't exactly build credibility with me. But more importantly here, what I'm particularly interested in is the fact that the type of information that he is sharing will get you in trouble if you try and go about approaching that. So I happened to post and reply on this particular Instagram reel, or whatever they call those things, the videos that they put on there. But I'm going to go through and I'm going to break down what it is that he's saying here for you today. And then I'm going to go and I'm going to tell you what is accurate, what is inaccurate, why it is inaccurate, and then we will cycle around to how it is that you can do something that's a little bit better. So let's dive into that. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. As I was mentioning, I'm Michael from Offshore Citizen. We are global international tax and relocation specialists. So we assist you with figuring out how to pay the lowest legal amount of tax possible for yourself personally and for your business, setting up corporate structures around the world, relocating to other countries if that is of interest to you to improve your quality of life, your freedom, your plan Bs, all those sorts of things. And so if you're interested in help with any of that sort of thing, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There I will give you personalized advice specific to you on what is the best solution for you. And otherwise, you can also reach out to us through our website by sending a message through offshorecitizen.net. Okay, so let's start by taking a look at this video really quickly, and then I will break it down for you. So here we go.
Let's look at Nike, for example. Nike doesn't pay any tax. Why does not Nike pay tax? Well, I'll give you a very simple version. They have two companies, one set up in Belize with a 1% tax rate, one set up in Europe. The one set up in Europe sells Nike trainers, pays all the staff, pays the stores, sells all the shoes, makes all the money, boom, makes millions and millions and millions of profit. The one in Belize owns the trademark. So after 100 million, 200 million, whatever it is, comes into the European company. The European company has a debt to Belize to use the trademark of all the profit. Yeah. Isn't that coincidental? That goes to Belize. Then Belize government comes along and goes, give us 1%. Nothing. Boom, boom, done. Tax paid. It's all a scam.
All right, so let's go through what is accurate and what is inaccurate. So to start off with, he's talking about Nike or Nike. I guess we call it Nike in the West and Nike in Europe. And he's saying that they don't pay tax. So first of all, this is a fallacy. Nike does pay tax. Depending on the year, they have paid somewhat lower tax or somewhat higher tax. So it's typically, I mean, you can go out and you can read their financial statements, but they certainly do pay tax. Now, I think what he's referring to is a popular article and story that got circulated around that they hadn't paid any federal income tax in the US. And I really want to emphasize the specifics of this because I notice this happens quite a bit, where there will be an article that comes out that quotes into like a very narrow area of tax and says, oh, this company didn't pay tax. It's like, well, no. The whole point is that when you're doing business internationally, you get tax credits for taxes paid abroad. You certainly at times have gotten tax credits for state taxes versus federal, and then there's various different other aspects that go into this. So what has been true at some points in time, not all years, in some years actually the tax rate was quite high that they ended up paying. For example, in I believe it was 2018, 2019, taxes were very high for Nike. That being said, what sometimes happens is that their US federal tax, note this is not their state tax, this is not their federal tax in other countries, it is their US federal income tax, has been low, okay? So we're gonna talk a little bit about how they do that, which is not at all what Andrew Tate says. So what does he say? He says, well, and this is by the way a super common narrative, look, you know, they're just gonna do business, they've got an entity in Belize, they don't have an entity in Belize. A company like Nike would never use Belize. Belize is really not a great offshore haven. They do have entities in Bermuda, and certainly Bermuda is probably a more popular place for certain types of companies. However, most companies aren't going to use Bermuda either. It is pretty useful for insurance. Captive insurance was really commonly put in Bermuda, but definitely they're not using a Belize entity. So this Belize thing is nonsense, okay? Now, so he says, all right, they've got this entity in Belize, and the European entity is busy selling things, doing all this stuff, but they're paying a royalty back to the Belize company to suck all the profit out. So they don't have profits in Europe, but they do have profits in Belize, and they pay 1% tax on that. That's what he's saying. So why is this wrong? Okay, first of all, let's start with the fact that you cannot simply decide, oh, I'm magically going to take all my profits and decide that's attributable to some other country. So anytime you have two companies that you own that are in multiple countries doing business with each other, this is what's called a transfer pricing arrangement. Transfer pricing is highly regulated. You have to do these detailed transfer pricing studies, and you have to charge fair market rate for that, which will always involve profit on both sides, okay? So it is entirely true that you can have, whether it's licensing rights, IP, etc. I'm going to talk in a minute about why that's generally a bad idea and why it's generally not used. But this being said, theoretically, you could have licensing IP rights in a particular country. You could also have certain services in some country. You could break out and have manufacturing somewhere, sales somewhere else, etc., etc. So you can separate out different functions between different countries. But the rate that you charge between them is going to have to be a fair market rate, okay? You can still gain some advantage here, but it's highly regulated and definitely not going to give you, this entire elimination of your tax. Will not happen, okay? So that's number one. Number two is that you're going to be subject to royalty withholding taxes, okay? So anytime in most of these kind of developed countries, you are utilizing, there's royalties revenue paid out from one country to another, they're going to do withholding taxes. So let's just use a simple example of the US. In this case, he was talking about Europe, but Europe has many countries, so we'd have to pick country by country. In the case of the US, if there was a US company of Nike, which was paying royalties income to Belize on some sort of a transfer pricing arrangement like this, what do you think the withholding tax would be that the Belize entity would be subject to on that income? The answer is 30%, okay? 30% tax, which is actually higher than the US federal tax rate, right? The US federal tax rate is 21%, so it would actually be worse for you to do that. Now, usually it's abnormal that the rate would be so high relative to the actual local income tax rate, but the point is you're not really going to gain a substantial advantage. If you're doing it between EU countries, then you can take advantage of something called the EU Royalties Directive, and you can kind of eliminate that, which is useful if you're going into the right countries. And so, there is some planning which can be done in that regard. And there's also some other nuances that can take place depending on which country's rules you're looking at. However, it is absolutely not true that they are doing something like this, okay? It simply doesn't happen. Now, what has happened in the case of Nike, and certainly kind of how you account for their fluctuation in taxes, because you'll notice is they had a lower lower effective tax rate, meaning that the amount of tax that they paid in the US relative to their total income was lower, and then it spiked in those 2 years, as I mentioned, and then it went down, and it kind of continued on at a lower level, right? Why did that happen? Okay, so you can absolutely defer tax internationally in many, many cases, okay? Meaning that rather than bringing the money back to the high tax country, a company can choose to leave profits in a lower tax place and simply have that tax liability and not pay the tax until it comes back. So what happened was after the Trump Tax Cuts and Jobs Act, which came in at the end of 2017, they introduced GILTI tax, they introduced the participation exemption, and they introduced some incentives which basically incentivized all sorts of companies to bring a lot of money back from offshore. So essentially, for a series of years, they had gone and they'd kept a lot of money offshore. This was artificially lowering, though temporarily, their US domestic tax bill. Okay, keep in mind, they were not eliminating that tax bill, they were simply deferring that tax bill. Okay, now deferral can have a value, so people underestimate the value of deferral, but the point is it is deferred, and you should recognize the difference. Then, when they had this incentive, they brought back all this money, which meant that their effective tax rate relative to their earnings for that year was actually much higher because they were basically bringing back money from previous years. Okay, so you had this seeming spike in what the money looked like, or what the taxes paid looked like relative to the overall earnings. Then after that, you settled down that they had GILTI tax. Okay, so GILTI tax was the implementation. It's essentially 10.5%, but it's much more complicated than that. I've done some videos on it specifically. So the bottom line is that you had this system whereby they could defer in the right places. They could pay a lower tax rate than the US federal rate, and then they could actually bring it back through the participation exemption and end up in a situation where now their effective tax rate was lower than the US federal tax rate. And that's perfectly legitimate planning. Okay, so we help people with that sort of thing all the time. It can be done by all kinds of different companies, small and big. And so that would be kind of the more modern strategy for a company like Nike that is a US-based entity. You still end up having the shareholders get taxed when dividends are distributed to them, although it's of course really common these days for companies to participate in share buybacks instead, and so essentially drive up the price of the stock, and then you can borrow against the stock, and there's some other fancy planning around that. But the bottom line is, what he is describing, if you were to try and do that, you would get yourself into a whole bunch of trouble, it wouldn't be effective, and it's simply not worth doing. So, not to say that there aren't legitimate strategies, aren't to say that there aren't ways that Nike is reducing their taxes legally, but it's definitely not what he's describing, and certainly not to the extreme degree that he is describing. So I hope that helps. Again, if you want help on it, reach out to us, book a call with me, or go to our website, send us a message, and I will look forward to seeing you on the next video.